All right, it's Friday again, and so that means it's time for a market update. It's been a relatively interesting week, and especially in terms of news from the central banks for the US and the UK and others around the world. So let's take a quick look at what has moved the market and what I'm looking at in terms of the portfolio for the future. So the indexes have continued to sell off. These are the weekly charts. So over the past 2 weeks, two nice red candles down. It looks as though the Nasdaq is trying to hold the 11K level. So let me change to the daily chart, and you can see we've bounced around that level for a while. If we manage to hold it, it'll become a nice support. By the way, I don't usually talk TA, but at times like these, I find the markets are driven more by TA than fundamentals. Fundamentals may come into play later on, but we need to see how the volatility plays out first. So if the Nasdaq does break the 11K level, I suspect we'll see it move on downwards. I don't know if it will stay above or go below. Nobody does. And if anyone does, don't believe them. But a break of the 11K level would see some confidence levels burst, and so we could see a bit more selling. Looks like there's another okay support around 10.5. All right, so the sell-off has predominantly been in tech. The Nasdaq 100, by the way, is not just made out of technology companies. You've got an airline in there, and you've got hotel companies in there. So there are stocks in the Nasdaq 100 that are still a long way from recovery. And they will recover. It's just going to take quite a lot of time. What we might see is a rotation. So you'll hear people talk about a rotation. And a rotation to value is a term that you might hear. And that just means that investors will take their profit out of stocks or sectors that have profited nicely recently, and they move them into other parts of the economy that haven't fared as well just yet, and where the stocks might be looking cheap. And so some examples of those, you'll see I've got JP Morgan up here, are the banks. It's quite often you'll see a rotation from technology into the likes of utilities or finance. And some of the big US banks are starting to look very attractive. Their prices haven't got anywhere near recovery levels. Their prices are still low there are some good reasons. Low inflation does hurt some of them, but also high volatility helps a lot of them. So those like JP Morgan and others, they're some of the largest investment banks in the world, and investment banks in general, they tend to benefit from volatility because people trade more. So they make money either directly or indirectly. So I have been looking at some banks. I quite like Blackstock. Blackstock is the largest fund manager in the world. I think they still are. And so they're almost entirely an investment bank. And so they make a lot of money out of volatility like we've experienced. But also now that we're approaching the US election, I think we're going to see a lot of this. It's not going to be a straight line up anymore. It's going to be up and down as we go along. And BlackRock is likely to make a lot of profit out of that. And you don't want to be buying BlackRock a week before their earnings. You want to buy them much earlier so that the price is much lower when you're anticipating that there might be a stellar earnings result. So I did pick up some BlackRock recently, and we'll see if I end up getting any more. You'll also notice that recently through the volatility periods, the past 2 weeks, 3 weeks, I've been trading a lot more frequently and taking smaller profits. I'll only use maybe 10 or 20% of my portfolio to do this. I'll maintain my long positions because I do really believe that they're going to do well in the long run. But when there's volatility, it's nice to grow the cash pot when things are moving up and down. All right, I will share my trading ideas. Some of the things that I've just discussed are in here already. Just by the by, you for those that know, Nvidia has been on a tear for a while, and I am very bullish on Nvidia. I think given the rise in AI and just how good they are in the various sectors that they operate in, the stock price is just, they're going to be a mega cap in the next 10 years. There was a fairly nice rise. I'll change this to daily. Off the back of the news that they would be acquiring ARM. ARM owns the intellectual property behind various chips that are used in so many devices, mobile phones and laptops around the world. And if Nvidia were to buy them, then they would be able to license out their intellectual property to other companies, or to not give it out at all. So they can't just buy them because they need to get approval from a number of different governments. One of the governments involved is China, and China is not so happy about this deal. China and the US obviously have a bit of a political battle going on, have been for a few decades, I guess. And China is worried that if Nvidia were to acquire the intellectual property that ARM owns, and Nvidia is a US company, that they might no longer have access to those to be able to license the technology to use for themselves. And I think this is a very relevant concern. So China might block the deal. So we might see Nvidia share price tank a little bit. But I'll keep an eye on that. I am looking to build up my position in Nvidia over the long term. Something that's happened that's been particularly interesting, and I'll talk about that for a while, is that the Bank of England has said that they're going to keep interest rates flat, but there is a chance that they are going to cut them into negative territory. And it's very interesting. It has a number of different impacts, and nobody understands what all of the impacts would be, the long-term impacts would be. But effectively, they would cut these rates into negative territory to try and boost spending. A few things that happen when you cut rates this low is that people are more inclined to borrow money, but also banks want to get money. They don't want to hold on to money because they can't make interest out of it. They want to loan money out and make money off of the fees that on these loans, usually retail loans. So the pound has sunk on the back of this news, and that is another way to help the economy, because things that are priced in pounds become cheaper relative to other currencies. And that means that we might see a lot more foreign investment. People might buy stocks, but they also might be willing to invest in other areas of the economy. One area that I am quite interested in the UK economy, there are quite a few UK companies that are in the mining industry. I've bought a few of them over the past 2 weeks, anticipating something like this. And the reason that these companies are interesting is that if interest rates are cut into negative territory, that means that their stock prices become cheaper for Americans or Europeans. And also the volatility that we're experiencing, the coming inflation that everyone is anticipating, mean things like gold become more attractive. So the value of those businesses goes up if they are mining and selling precious metals, because the thing that they're selling has become more valuable. So that's one. I will be keeping an eye on any additional opportunities in that sector, particularly in the UK, because I think it could do pretty well over the next 1 to 5 years. Something else that has been interesting is that UK retail has bounced, and now retail sales are higher than they were before the Great Lockdown. There's a weird mix of positive and negative news, particularly around the UK. But the reason that I am focusing a bit more on the UK is because the US, some parts of the US have seen a massive recovery in their stock prices, and investors, part of the rotation will be to other sectors within the US, but it'll also be to other areas in the world. And if the pound is cheaper and businesses are doing well, we could see money pour into various sectors. Retail obviously looking pretty good. And if we can front run that investment, then we can make money off of it. So companies like ASOS, which is so far the most profitable position in my portfolio, could see a nice boost. I think ASOS is going to run wild anyway because they've just expanded their operations globally. But I will be looking for other UK retail opportunities, probably less the brick and mortar side, more companies that are good at digital retail, e-commerce. Some other side effects of negative interest rates are that retail banks could be in trouble. So I said before that low interest rates mean that companies are more willing to loan money out. They get a little bit loosey-goosey on their policy, but they still might not make a lot of money. So a lot of banks, they take the huge amounts of money that people deposit with them and they invest them in other places. And the way that they make money is off of the interest on your money. But if some of the places that they lend their money to, your money, aren't giving them good interest rates, then or negative interest rates, so these banks end up paying the people that they lend to lend to them, then obviously their business model is a little bit in trouble. A few of you have asked about my NatWest position, understandably so. I mean, lots of my positions are doing quite well, but if you look at some of these, mine is 59%. And NatWest is a strange one. They've encountered some weird hurdles. So if I zoom out a little bit, their old CEO left the business, a new CEO came in. She said she wanted to restructure the business, and Wall Street investors hate the word restructure because it usually means breaking up the business. It's very expensive and there's risk about it, how successful it might be. Part of what she decided she would do is close down the investment arm of NatWest, which I'm also not so happy about. I don't know if that's a good move in the long term. And obviously there was the great lockdown, so the stock prices tanked. If memory serves me right, NatWest was also asked by the government to loan money as part of the various schemes that it created to prop up businesses, and some of those loans will default. So people have sold off RBS pretty strongly, and now there's a concern, if we go negative interest rates, how will these companies be profitable? The reason that I'm willing to hold NatWest even at minus 59% is, if you look at NatWest's books, the current share price is ridiculous. So NatWest's market cap is $15 billion. Let's call it 12 billion pounds. The enterprise value is negative, which is something that you almost never see, and I'll talk about why in a moment. So the company has been, keeping revenue fairly stable. It has dropped off in the past few years. They've been tidying up their business, making their business smaller, so a decrease in revenue makes sense, and they've done this in an effort to be more profitable. But if you go down to their balance sheet, they are sitting on 113 billion pounds of cash. Incredibly strong cash position. Banks usually keep a lot of cash on hand, though. They've got negative debt, which means that they're holding a lot of cash when all is said and done. And then their book value, or net asset value, is a measure of shareholders' equity and is calculated as assets less liabilities and any preferred stock. So what book value more or less means is, if the company were to go into liquidation, how much would would the assets of the business be able to be sold off for? And a large part of this book value is cash, right? So it's not like they have a lot of equipment, it's cash. So if RBS went out of business tomorrow and you were an investor that held some of the stock, you would not be getting 98 pence per stock. You would be paid out a representation of the book value. So 43 billion pounds versus the 13 billion pounds. So you can see that the book value of the company is roughly more than three times the market cap. So if you were to be paid out, if the business sold tomorrow, you would receive 3 times the share price. So you can see why it's crazy that the share price is there right now. All right, there are a lot of other nuances around negative interest rates, and even some of the greatest investors in the world, they do not know what will happen with long-term interest rates. This is a massive experiment that hasn't really been tried. Japan has had negative rates for a long time, but negative interest rates across multiple economies is not something that has really been done. So hold on to your horses. It's going to be quite a wild ride, particularly because we also have Brexit on the horizon. And the BOE has signaled that they're quite worried about it, and that's part of why we're seeing UK stocks sell off today. But I think that news will settle, and there'll be some really good opportunities in the UK market. All right. I hope you have a really good weekend, and I'll talk to you soon. Cheers.